Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. I'm your host, Yannis Papadakis, Business Development Manager on Crexi's auction platform, and today we're thrilled to sit down with Mark Earley, Head of Americas for Hines Private Wealth Solutions. But before we dive in, here's a little more about our guest. Mark Earley is the America's head of Hines Private Wealth Solutions and serves as Chief Executive Officer of the broker-dealer affiliate. His leadership has been instrumental in the firm's $10.7 billion capital raise throughout the wealth management channel. Mark also directs the overall strategy for the Americas and provides tactical guidance to the organization with particular focus on product development, distribution, sales management, and business planning. Additionally, he serves on the capital markets committees of Hines. Mark, welcome to the podcast.
Thanks, Yannis. Happy to be here today. Thank you very much.
Well, I've been really excited for this episode in particular because we're going to cover some new ground on the podcast today. But before we jump into it, I know we covered a little bit about your background, but I'd love to learn a little more about your career path and some lessons learned along the way. Can you tell us more about where you're from and how you got started in commercial real estate?
Sure. Well, I took a kind of a long route to get to Hines. Actually, growing up, my family was actively involved in the residential rental and multifamily properties. I was the teenager that was the cheap labor that was out mowing lawns, painting walls, fixing kitchens, taking late night calls when something went wrong in one of the properties. We also had quite a few rental homes, so really got involved with it as a teenager. And then into college, I got my salesman's license, my Texas real estate salesman's license, and was brokering product during that period of time. And then graduated from college and left and moved to Dallas in 1986. Actually, I was an industrial real estate broker, and so that was a very challenging time. That was the years of see-through buildings in Houston, Dallas, et cetera. So it was very tough to get things done at that period of time. And so I did that about 3 years and then was recruited into the financial services space. And actually I worked there up until about 20 years ago. So I started my career in New York Life Asset Management, worked for BlackRock for a little while, and then Morgan Stanley before joining Hines. So it was a circuitous route to get back to the real estate space. But it's been a really, really great journey, and it's really worked out well to where we are in the cycles today and where firms are and raising capital through the high net worth channels. It really set us up well and set me up well for that stage of my career.
Excellent. And can you walk us through a little bit of your early career and kind of what led you to join Hines?
Yeah, so I started to see this a lot at Morgan Stanley. When we were there, we ran a region there. And a number of the advisors that worked for us at that time were like, we want something else. We have mutual funds, we have ETFs, we have annuities, but we know we've been reading about this nascent asset class called alternatives. Real estate was a part of that. And as they built out portfolios for a lot of their high net worth clients, they found that a lot of these clients wanted something besides just a standard allocation to stocks, bonds, et cetera. And so that was really, really at the very beginning stages of that. And then about 20 years ago, I guess, 21 now, Hines called a group of us that were there, and they said that we would like to start to enter the real estate. We'd like to enter the capital market space through individual investors, financial intermediaries like the large banks, Morgan Stanley, Merrill Lynch, and others. And then what they would like to be able to do is access capital that way. And what led them to that, which I think is very interesting and also very fortuitous by the family, was that they saw that they had traditionally funded a lot of their large office projects, other buildings, both domestically and globally, through your large pension plans, where people, firms went out like IBM and GM and California State Teachers, and people would contribute their money there, or the firm would contribute, the company would contribute their money, and those pension plans then had to invest the money on the behalf of their shareholders for their retirement. And what they saw was that those pension plans were being reduced or being replaced by 401ks. And so once you got to 401ks, how did Hines, looking out 15 to 20 years, actually have the ability to access individuals' money once they left a 401k and they took it to financial advisors? So that's what they were really focused on. And it was very fortuitous for them to go in and say, okay, we're going to be in this space years from now for a long, long time. They do typically look out 20 years or so. And they're saying we want to be able to access that capital so we can have access and be able to capitalize properties, capitalize buildings in going forward in the near future. So that was the genesis of launching the Hines Private Wealth Solutions years ago. We just rebranded it. But we started as a small, there was actually 3 of us in a one little office in Houston. And we had 3 telephones, and that was it 21 years ago. And so now we raised about $10.7 billion, almost $11 billion now. And it's been a very successful outcome for the firm and a great source of additional capital to the firm besides the traditional pension plans and others.
So you've been with Hines for now over 20 years. What were some of the biggest wins and challenges that you faced throughout your journey with the company?
Yeah, that's a really good question. And when you've been somewhere 20, 21 years, you have a lot of those. I'll really start with the challenges, though. One of the things about raising capital through as a financial intermediary, through the banks, et cetera, registered investment advisors, is there's a tremendous amount of regulation. And you have regulation at the state level, you have regulation at the national level. For instance, we have our own regulatory body called FINRA. A lot of people have heard of that. The SEC, obviously, at the national level. And so you're constantly navigating new regulations that are coming down from the SEC, that are coming down from FINRA, on how you distribute these products and how you access your clients, what they can see in marketing material, for instance, what you can publish. It's very, very, it can become very, very tedious and cumbersome. It's also very, very expensive. And one of the benefits of that, obviously, is it creates a barrier to entry if you're not well capitalized. So it kind of builds this moat around a lot of the things we've been able to do because what we can do, we can go out and we can absorb some of the costs of those before you can get to scale. So that's one of the big challenges. Obviously, economic cycles, right? Been through a number of those. 08 was the biggest, significant drawdown there. I will say one of the things that was very interesting about 08 that we found at Hines was that what happens typically is when values fall, as you know, you have what's called the denominator effect. In other words, if pension plans are allocated and they've got a 15% allocation to real estate, and all of a sudden their stock portfolios drop by 10 or 15%. Now they've got a 17 to 18% allocation to real estate. They cannot add any more. And one of the benefits of raising money from the retail channel during that period of time was that while we couldn't really raise a lot of institutional capital there, we were still able to go out and raise quite a bit of retail capital because a lot of the retail investors saw the opportunity in the downturn. I felt like there was a good time to buy in. So we actually raised a lot of money. So while it was a challenging period overall for the firm, we worked our way through it. It was really interesting to see how the two sources of capital really were able to sit side by side and complement each other during that period of time. And then I'd say the third biggest challenge was COVID. I'm sure you've had people on your podcast, you've talked about it ad nauseum, but it has completely changed the way that we are working, living, shopping, et cetera. And we're still seeing, and we're going to see for a long period of time, how we develop new products for tenants, new buildings for tenants, how we access capital for these new types of products and new types of buildings. It's just really, office has fundamentally changed. Pre-COVID, retail, open air retail centers, everybody thought they took a big hit. Now they're one of the hottest real estate classes because there wasn't a lot built. And because of the fact that people don't want to go to malls now. They don't want to be inside. They want to shop outside. Multifamily, we had continue to have a shortage of multifamily and how they work. So those are, COVID has just completely changed everything, and how we're starting to see how people adapt to that. But it's going to be very, very interesting to see how we meet that challenge and go forward. But those are the three big ones.
And you mind sharing some of the big wins?
Oh, sure. So some of the big wins, I think, were over the years in our, as far as within Hines, but also within our specific group, we're being able to offer multiple offerings that give investors different access to our different products. So, for example, we were able to offer an open-end REIT that people could access. Then we rolled out, people wanted more high net worth offerings, so we rolled out a direct investment program. In other words, you or I could work with a financial advisor to access one of our development opportunities and come to us through them direct and be investing alongside Hines and other investors in a direct development program. That has been very, very popular with a lot of our clients and our high net worth investors. And then the third is, the biggest win is, we're going to talk about a little bit later in the show, but a little bit is the launch of the Delaware Statutory Trust 1031 721 exchange program, which I know we're going to get to. And we have just seen the interest in that grow exponentially month over month.
Now, can you share a little bit about how you've seen the industry evolve since you started and how Hines has adapted to some of those changes?
Yeah, one of the biggest things that we've seen really over the last 20 years has been the real focus from tenants and their employees on green buildings. So for many, many years, Hines was a leader in the sustainability space. I'd actually helped write some of the guidelines for the LEED certifications that a lot of your large office buildings and other buildings they're used. And so we've always been really focused on that. But 21 years ago, your tenants were glad to see it because it did make the building more efficient, costs were down, et cetera, but they weren't as focused on it. You fast forward now, really the last 15 to 20 years, when tenants come in, they want to know about the building, what its LEED certification is it green? Does it actually put electricity back on the grid? We built a building like that in San Diego. It's actually net neutral for electricity. We actually sometimes sell it back to the grid. And the reason for that is a lot of their employees are asking. And so if you think about a really big change going over the last 10 or 15 years, really, is everybody's glad to see it, but not a real priority, to now it's a large priority, especially in office. And then, of course, the rise of industrial was a big, big change. I was actually an industrial broker back 40 years ago almost now. And it was not near the same space. And then you get to where it was starting to pick up a little bit 20 years ago. And now, it has the same, it's year in, year out, has held the same growth line really as what your GDP is in the United States. Continues to grow, continues to grow, continues to grow. Online shopping really accelerated that trend. The ability for these warehouses to have 28, 30 foot and higher clear heights, the automation that's taking place. I'm sure your clients have all read about what Amazon is doing with robots and a lot of these warehouse buildings and how it's becoming automated and how they're becoming much more efficient. So you got the green buildings in the area, how the industrial sector has continued to evolve and accelerate. And then I think one of the bigger stories, and I'll probably mention a little bit earlier, is, coming out in 08 and 09, the multifamily, single family home shortage here in the United States is acute. We really have lagged. We're behind by almost 6 million homes, I believe, coming out of 2010, based upon the United States household formation. And so while we have had some small cycles in the multifamily space, what you've really seen is you're going to need to continue to build more and more homes for people, as well as single family build to rent. So those are the three big I would say, key areas that if you look back have had significant changes. And the fourth would be really what's happened with a lot of your enclosed malls compared to what's really taken place with your open air outdoor shopping centers that we all go to, anchored by Whole Foods. Go get your Whole Foods, and then you walk into all the different experiential retail that's on each side. And so, people used to flock to the malls, and now it's only really all about open air shopping. If you see a lot of the large developments and lifestyle developments today, they're all about open air, beautiful landscapes, everything is more developed to be outside and be a really significant lifestyle versus just an enclosed mall. So those are the really four
Right.
areas.
And and synergy between tenants too in that space as well.
Oh yeah, that's really, it's really a live, work, play type environment or a lot of things that we do. So you might have retail on the bottom, to your point, and then you might have apartments on top of that, where people can live there, walk downstairs, maybe a green space or a park that's been placed in between a lot of multifamily product.
Mm-hmm.
And near a transportation hub, for instance. So there's just a tremendous amount of how and that's so much different than the way it used to be. Just throw up a big multifamily building and no amenities around it or anything. And if you take a look in Dallas, where we spend a lot of time, it's the Jerry Jones Star in Frisco. If you're ever out there, he's put his practice facility there in the middle. There's a tremendous amount of shopping, restaurants, multifamily. You literally can walk less than a half a mile and there's everything you need within that one area. I mean, it's really fantastic for people that want to live in those areas.
So I didn't get to see that, but I was just in Dallas at one of the ICSC conferences, the Red River one, and I did get a chance to get out a bit and see some of the new retail that has been built. And it's impressive to see how much development is going up, and really seeing people out there and engaging with it. So I'm glad to know that you're putting your fingerprint on it.
Well, it's one of our main focuses. We really believe in that space, the live workplace space, and really are designing a lot of our projects around that and how they work, and just we know that's really the future, and that is an acceleration coming out of COVID. It was starting to really go, but coming out of COVID, it's almost a necessity now that you provide that type of environment around your multifamily, your retail, et cetera.
Right. Moving on, I'd love to hear what you think about which qualities or mindset do you think is essential for successful entrepreneurship and commercial real estate?
Oh, wow. I think the first thing is, as we've been talking about change a few minutes ago, you've got to be creative. Mm-hmm. If you get stuck in what you were doing and trying to continue to do the same thing over and over again, at some point, you're going to get stuck in a product or an investment that's not going to be meaningful, that's not going to be leasable, that someone's not going to want to be there. And so as these products evolve, you got to get creative. You got to think ahead. You got to kind of look out in front of where things are and try to come up with new ideas. And part of that too, the second part of that, I think, for an entrepreneurship is you got to be comfortable with change. If you try to hang on to those things that you've done well in the past and hope that they're going to continue to do well in the future, you're going to be severely disappointed. Because if you just go back and what we've been talking about here in the last few minutes about the change in the real estate market, you're in a situation where if you'd have just stayed with 18-foot clear height industrial properties and not tried to go up, if you hadn't tried to automate with those, if you hadn't gone to live, work, and play, everything you were doing new would not work. It'd be obsolete. And I think it's probably the third one is tenacity. It can be really hard working on new projects and new product, and you've got to stay the course when you believe in your idea. If you don't believe in your idea and you don't stay the course, it'll just fade away. And That's one of the things I think that Hines has taught us, being there many years. Hines is a very entrepreneurial type company. And once you starting businesses, trying to do new things. And so you're always bumping up against, people that maybe don't see what you see. So you got to have the tenacity to continue to push forward and sell those ideas. And if you read any biographies, if you read about a lot of successful people, many, many times it was not the first time that they actually spoke with someone about their idea or tried to raise money or put up a new project. It might have been the 50th or 75th or 100th time that they finally broke through. And so that tenacity is just very, very important in our space. So that's where we really, and I think in the commercial real estate space, in the investment space where you have clients and investors, your track record and your reputation are everything. So when your primary focuses should be to guard that carefully. Always attempt to obtain the best outcome for your investors, manage your reputation, and everything else will take care of itself.
Great advice. All right. Now, if you're ready, I'd love to move on and dig into our topic for today. And today we're talking about the world of the 721 exchange and Delaware statutory trusts. Now, for our listeners who may be unfamiliar, can you explain what a 721 exchange is and how it works in commercial real estate?
Sure.
And before you get started, I know that most listeners like myself probably have only heard of a 1031 exchange.
Sure.
So why don't we start with what a 1031 exchange is and then move on from there.
Okay, that's a really good idea. Because what I'll do, I'll kind of use a 1031 to build up to the 721. I think that might make it a little bit easier. As I was telling somebody the other day, sometimes we use a whiteboard to describe all this. So I'll try to get it done here where everybody can see that they're watching or listening. So a 1031 exchange, most people know about, is where you sell one property and you exchange it into another property of similar like kinds. So maybe you have a duplex and you sell a duplex and you buy another duplex with the proceeds and you don't pay any tax on that. So that's a very simple 1031 exchange. The next place you would go, and this is based upon what the SEC allowed, some ruling from the SEC in 2009 allowed to do, is they allowed you to buy in what's called a Delaware statutory trust, fractional interests in a building. So in other words, instead of a one-to-one transaction, you can go out, let's say there's an apartment building, we can purchase it for $50 million. We can aggregate multiple investors for that $50 million, and they can all exchange the sale of their property into the units of that trust. And then the trust, it is like a trust. It is managed by someone like Hines. So you don't have the active investment of the active investment of the asset like you do in the 1031 because you're still managing that duplex, for example. Here, the trust manages it. So you take your proceeds, pool them with other investors. And once that's pooled, then the trust owns and operates that partnership. And they operate it based upon certain rules that the IRS has set down that trust has to operate into. And they're very long and lengthy. I won't go into them today, but the big part is that trustee always knows those rules and operates within that. And then the 721 exchange is another ruling from the Internal Revenue Service came out. And that basically allows to take that trust, which is a fractional ownership, and then exchange it into a REIT for the shares of that REIT. So you're basically in the trust, you're in operating partnership units, and you can transfer those into the REIT through an UPREIT, what's called an UPREIT exchange. So kind of think about it as the 1031 is on the bottom, like kind to like kind. The DST, all right, allows to go from the sale of your property to a larger property with pooled investors. And then once that trust is created, it has the ability then to exchange its OP units for shares of the REIT. So it's kind of like a building block there. There's 3 different ways that you can do it. And so what that does, it obviously allows the DST as a trust. And when people see DSTs /721, what they're saying is we're going to do a DST and then we're going to exchange that at some point into a REIT.
So just to kind of spell it out a little more simply here, and correct me if I'm wrong. So it sounds like if let's say you're planning on doing a 1031 exchange, or you want to do some kind of exchange to defer taxes, instead of replacing your property with another property that you would manage, you could exchange your property into a DST, and potentially, instead of buying a property of similar size, you could leverage into a much larger asset in which you would own fractional shares as part of the DST.
That's right.
And, that's being managed by, a trust. So, you don't have any management responsibilities once you've exchanged out of your property into the DST. And then that property that's in the DST is then acquired by the REIT?
Yes, it's acquired by a REIT at the fair market value. So it sits within the REIT, but it still sits within the REIT until the time you get ready to redeem your shares. It sits within the REIT, still in that trust. But then when you get ready to say, okay, I want part of my money out, then it will get redeemed, and they exchange your OP units for shares of the REIT at that time.
Interesting. So this must present a pretty unique opportunity, especially for people that are doing, long-term, wealth planning or even trust planning for their estate. Instead of, let's say, passing your property on to, 5 kids and 15 grandkids that, all have to decide on one building.
Right.
They could all have, shares of that REIT in equal part, or, however it's divided up.
No, that's exactly right.
Wow.
That is probably the number one benefit in estate planning used for estate planning. And that is when the kids, I'll run you through it just like what you talked about, and a little bit more color maybe is, what happens a lot of times is those 5 kids, right? One of them wants the money and maybe the other 4 don't.
Right.
So one of them's like, I don't care. I'll pay the tax. I want the money. The other kids are like, we don't. So what the parents can do, to your point, is they can take that asset, put it in a DST, and then in 2 years it's uprooted, and they can, gift the shares to each one of those kids that one child can sell if he would like to. Now, one of the benefits is they're going to have a cost basis when that asset is exchanged into the DST and into the REIT. So they could actually sell their cost basis first and not incur a tax, and leave their other shares there to grow, collect income, do whatever they would like to do. But that way, one of the kids can say, okay, I want my money. The other 4 want to stay in and don't pay any tax. So that's one of the biggest reasons a lot of people do that. You're exactly right.
So you would still have a stepped up basis if you inherited shares of this REIT that came from, a 721 exchange that previously used to be, let's say, the family owned apartment building, right? You
get a step up.
So
you get a step up in basis if they die. You get the step up.
Right. If the original, holder passes and then it moves down that way, but you would still get that step up in basis even if it has been turned into those REIT shares via 721 exchange.
That's right. You do get the step up.
Wow.
Yeah.
That is incredible.
It's a great opportunity. So one of the big benefits, if you think about it, within the 1031 exchange, just as a reminder for everyone, you have a 45-day period that you have to identify an asset to exchange the one that you just sold into. And then you have to complete the transaction within 180 days. So what
A lot
by
of pressure.
creating this trust of the DST in this large asset, there are firms like ourselves that will have these assets sitting out there available for that. Versus if you just got your one building, you sold it, now you got to go find something else. Well, many times somebody had a hard time, an investor may have a hard time finding another property to actually do a 1031 exchange. So this allows someone that maybe couldn't find another property to actually go direct into the DST and not trigger the capital gains tax if they were not able to actually invest within that 180-day period too. So that's been the big benefit of this as well, is a lot of people used to get stuck and not be able to get their transaction done within that 180-day period.
Right.
Here, this is by providing a lot of this product in the market, it's allowed a lot of people to continue to diversify.
I mean, I, just became more well-versed with DSTs and really learned how valuable they can be, especially with somebody that has that ticking clock of an impending, exchange that, maybe the deals you identified for some reason don't work out. What do you do? And, I learned how valuable DST can be as a solution for somebody that's, in an ongoing exchange, and for some reason their up legs don't materialize. I mean, it's really an amazing tool. I guess one of my questions I have is, let's say you go through this process, you exchange into a DST and then 721 into that REIT. At that point, could you exchange back into commercial real estate if, let's say, you found a building that you want to buy now, or you see a great deal and you're like, hey, I feel the itch to get back into property management for some reason, right? Is that something that you can go back into a building with?
No, that is the primary drawback to this. Once you are in the DST and up into the REIT, that's the end of the line for any further exchanges. So you can't go back.
Got
so
it.
So you're trading off the ability to continue to do 1031s for liquidity, estate planning, right? More frequent valuations and more diversified portfolio. But that's, there are a lot of people that do not want that to end as well. So they will just stay with a straight 1031. Right.
Interesting.
Yeah, you can't go back. Once you're in, you can't. The IRS has ruled you can't go back. Same thing in partnership, right? If you and I own a building together in an entity, and we both sell it, I make $1 million, you make $1 million. You can't take that $1 million out of our partnership and go exchange it separately. We would both have to go do that together.
Understood. Yeah. So it sounds like this is, a tool that's especially useful for people that are looking to exit the commercial real estate market at some point, right? If they don't want to, get back on the merry-go-round of exchanging into building after building, and they're ready to kind of, take their hands off and say, hey, I've made my money. I'm ready to, diversify my portfolio and put some of that money elsewhere in a way that's going to be easier for me to, not only manage, but also disperse to my heirs once, I do pass.
Yeah. It's great. If you think about it, so you move from, if you have debt on your other property, most people can have some type of personal loan recourse for that. They're going to have, so you get rid of that. You get rid of the fact that you have to manage the portfolio. Typically, all your REITs are going to have multiple assets within them. They're typically, the REIT's a little more flexible on your exit strategy. If it's a publicly traded REIT, you can sell the shares at any time. If it's one of our direct investing real estate programs, you can exit once a month, depending upon the liquidity provisions and if those provisions are available. So there's just a lot more flexibility there than you would have, and less. You're diversifying yourself out, right? So a lot of people are like, I just want to collect, to your point, I just want to collect my check every month. I don't want to take any more calls. And I want to be something that's a little more diversified and not take maybe as much risk.
Yeah. I'm tired of fixing AC units and sinks.
Yeah, exactly.
So I'm really surprised that more people haven't heard of this. When I first heard of it, I had to look it up because I didn't even know that such a thing existed. How would you say the popularity of, DST exchanges evolved over the years, and what trends are you seeing in this space?
Yeah. So as I mentioned a little bit earlier, I believe in 2009 is when the IRS really ruled on the ability for investors to exchange into the trust in increments versus just a 1031. And so there is an appeal for people to go, as we mentioned earlier, from I don't really want to continue to mow the yard or take the late night calls, etc. In this small property, well, I'm going to pool mine with a much larger institutional grade property that I might not have ever had access to. And so in 2009, once the rule changed, the tax code changed, that allowed that to start to be marketed. And so once that happened, so if you think about it, we're really only, we're 15 years into this, and that's really a pretty young, right? That's pretty early in the process.
Can't even drive
Yeah,
yet.
I mean, exactly. So it's still pretty young in the process, and so it's just growing exponentially. It's growing exponentially every year, and I think one of the big drivers is a lot of your large money center banks have started to offer that through their wealth advisors, and because of that,
Mm-hmm.
they have a lot of high net worth clients, obviously with a lot of real estate, and now it's something they can offer that they could not offer before because of the diversification of the portfolios, because they're going to be uprooted typically, and the diversification of the portfolios and everything we mentioned before. And so it's just still, like you said, it's brand new, can't drive yet, but it is growing. So, it's once people find out about it and you get on their list and people are going on, it really becomes compelling. But part of it is like what we're talking about today. You didn't really know about it, and you got 1031, you got all these acronyms, 1031, DST, 721, and it just takes a while for people to understand all that and really dive into it, and that has kept a lid on some on the growth. It's not a simple process, obviously.
Right. And, I imagine you really have to be familiar with, as, we'd mentioned before, regulations on how to appropriately manage somebody through this process, to make sure that you're
Yes.
going about it the right way. So, and I take it there's probably not a ton of experts out there yet that really understand, the fine points on, how to successfully manage somebody through this process to ultimately get to their investment goal.
There really isn't. There's starting to be a small group of commercial real estate brokers, residential real estate brokers, some financial advisors that are starting to specialize in this. They're actually doing classes, seminars, and really going out and talking to more people about it and making more people aware of it. So I think we've all seen the hockey stick before. It just kind of goes along before, and then at some point it kind of reaches critical mass and goes up. I think that's what you'll see here, especially now that we're in the middle of the greatest wealth transfer in history. A lot of that wealth transfer from parents to their children is going to be in real estate, and people don't like paying taxes. they just don't want to pay taxes, and it also helps with capital formation because you're continuing to move forward, and people can continue to grow. They can invest more this way because they're not paying the tax, and it's just it's a great vehicle for deferring tax. Remember, that's one thing I like to point out. You're deferring the tax here. You're not necessarily getting rid of it, right?
Right.
So, and we don't give
Right.
tax advice here, obviously, but you're deferring it. So I don't want to give the impression that people are going to get out of the tax, but you're just deferring it along the way, which allows for you to invest more each time and grow your portfolios faster.
Absolutely. And are there any specific types of properties or investment strategies that are particularly well suited for DSTs or 721 exchange structures?
There's really, uh, I don't know, multifamily is typically really good. these grocery anchored retail centers I mentioned earlier, well located, right, can be very, very good. Industrial, it's kind of it's really the properties that are benefiting from, your macro trends, but all of them can be put within any of your properties can be put within a trust, any of your asset class. You could put a data center in the trust if you'd like to, right? You could put self-storage, etc. You can put anything within that trust to syndicate out. And a lot of firms will offer different asset classes because some people, right, there may be some people, I would prefer to be in an apartment building. And someone else will be like, I just feel better if I could exchange my assets into an industrial property or a grocery anchored retail strip center. And so if you look at the marketplace, there's a lot of different types of asset classes that are offered for different people. And we think that will probably continue to expand.
Right. I'd like to take a step back real quick and kind of look at a broader macroeconomic standpoint. How are trends like interest rates, inflation, challenges finding leverage affecting the popularity of 721s and DSTs?
Well, it's made it your key point there is interest rates and financing. And so we still have a period of discovery here on transaction prices. So there's still some tension between what people want to pay and what sellers want to sell for. So we're not equilibrium there. Buyers want to pay quite a bit less than what sellers are willing to take. And when you have higher interest rates, you have to have leverage that's typically accretive. And with higher interest rates, it's hard to find properties if the sellers have not reduced the pricing enough to find leverage that's actually accretive to buy it that way. So in other words, where you may have had a $50 million apartment deal and you could have put $25 million worth of leverage on it. So you only need to raise $25 million. Now with leverage not being accretive, you've probably got to raise the entire $50 million because it's very, very difficult to get leverage. So that's really impacted it. And in some cases, in some parts of the United States and where this takes place, you're going to have that price discovery going on. And so you should start to see some opportunities for the DST syndicators to actually acquire some properties at these better prices. So, if you're thinking about selling and doing that, and some of these things are starting to come to market here over the next 12 to 18 months, there's probably going to be some really, really good buys. So that's really how it's impacted. I mean, higher rates, it's no secret, really, have impacted everything across the real estate spectrum. So right now, as we're just waiting, there's a lot of people that are waiting and hoping, that the Fed starts to lower rates and they're saved from these higher rates. And some people may be, but others we think it's going to create a really, really big buying opportunity here in the next 12 to 18 months.
Right. And, I've been hearing that across the board that, it's coming, it's right around the corner, but it always seems to get pushed out a little further. Do you think this year we'll start to see, a little more concession on sellers' behalfs to get deals done?
We have started to see that some now, probably not as much as we had anticipated. A lot of the lenders have continued to extend for their clients. You haven't seen that capitulation really yet. A lot of these lenders do not want these properties back. And so they're doing anything they can to extend this out. But really, even if the Fed does cut the rates 3 times this year, which they continue to, they pushed it out yesterday until maybe June again. Is that going to be enough? Because a lot of these properties were financed leading up into this cycle. It created a boomer. They're financed at 2.5%, 3%. Well, even if you cut rates 75 basis points, you're sitting at a 5. You're still well above where a lot of these other, where the original financing was there. So it's going to be we think there's going to be some breakage there, and you're going to see some big opportunities.
Right. Now, how can brokers advise their clients on DSTs, 721s, and implement their advantages into their businesses?
Yeah, so I would say that the first thing to do on the 721s and the DSTs is to find a is to search out. Every city has people that are doing this, that are actually educating on this process, and talking about what it is. There's actually a lot of online information about kind of how it works. And what I would do then is identify a financial intermediary that you could work with. So when you even when you do a 1031 exchange, you sell your property, you don't ever take control or have access to that money. It goes to a financial intermediary. That financial intermediary then holds it. And then when you go to close on the property later, they transfer that money over. And so it's a good idea to go identify some financial intermediaries in your area so that if you meet someone, and they're really the ones that can help you walk through that transaction you were talking about earlier. So they can walk you through and make sure that that transaction takes place and educate you on it. And that way that they can talk about the 45-day identification period, making sure it's done within 180 days. They'll hold the money. They can do calls with your clients to educate them on the business and how it works. And then I would also find a really, really good CPA if I'm a broker that understands this space, and begin to have meetings with he and your clients about the opportunities that are available here. That's really going to be important because you do not, as an advisor, broker, you do not want to give tax advice, so you want to have somebody there that understands how this works. And there's still the CPAs that we met with. There's a lot of them that are still in the discovery period about this. So it'd be a really good networking thing for that group as well, because there's a lot of them that would love to. Once we talk about it, they get real excited because they haven't really. They thought that all they knew really was all about the 1031. They didn't really know about the estate planning benefits of the DST and the 721 program.
Right. I mean, I was really excited to talk about this topic because I know, how little information there is out there right now about it. And so I thought, this is something that, once I learned how it works, I was like, wow, this is incredible. I can't believe more people aren't talking about this. So, and the people that are talking about it, real quick, are there different types of investors that are taking advantage of, DSTs and 721s right now? Is it mostly institutional? Are you seeing some private capital and mom and pop type investors
That's
taking
more your
advantage of it?
mom and pop, high net worth type investors. You don't really do the DST in your portfolios. Typically in portfolio transactions, you are trying to do some type of like-kind exchange to minimize your tax consequences, but it's not within the DST. So it's mom and pop, high net worth individuals. And that follows along with that macro theme of this is the greatest wealth transfer. That's where a lot of that money's coming from. Those investors, those people that are selling, getting ready to get rid of all this property, that are tired of dealing with it, as we talked about before, they're the ones that are really starting to embrace this and use it more.
Yeah. Got it. Well, Mark, I'm going to take us here to our third and final topic, which, this is something that we do here on the show. And given your background and expertise, I'm sure our listeners would be curious to hear you answer some of our rapid fire and words of advice questions. You ready?
I am ready.
All right. So if you were given $50 million today and had to invest it immediately, what would your go-to asset type and location be and why?
It would be multifamily and build-to-rent homes. Since, as I mentioned earlier, since 2012, we've formed 6.5 million more households than we built homes. And if you read a study from Bank of America recently, we're over $4 million 4 million homes short. It could take, some surveys say, decades for us to catch up with that. And so multifamily, build to rent, anything you can do, affordable housing, has got a long, long runway. and it's tough to beat the South and Southwest, given just the macro environment and the people moving there. Give you an example. You were in Dallas. You said recently for the Red River meeting, Dallas added last year over 125,000 people to the city. Mesquite, which is on the east side of Dallas, is a large city. They added a city that size last year to its metro area. Houston just a little below that. And so if you think about how many people that is, how many more homes you need, where they have to go, it'd be really hard not to go really, really deep on those types of products because you've got such a long runway, right? And if you're a little wrong, it's such a big macro trend that you can be wrong probably in some cases and still, do okay.
Got it. Now, up next, what's your favorite tool or software that you use on the job?
Well, I have to say, grudgingly, I moved from a paper tablet to the Remarkable tablet about 9 months ago. And now I take that tablet with me everywhere. The ability to organize everything in these notes, have them in one place, not carrying around a big notebook and then having to keep the notebooks on your shelf and go find it. And it's all right there. It syncs to your computer. I reluctantly did that, but it writes so well. That's been like an indispensable tool for.
Awesome. And what is the most common misconception about your job or industry?
That it's easy. Right? I mean, it's easy. So there's two parts. One on the real estate side. You may hear, here's the macro trend, here it is, and I'll just jump in that and make it work. It's not. It's very, very complicated. The second side of the capital raising space where we are in the capital markets, it's very, very intensive to raise money and expensive through the high net worth channels. And a lot of people in the 21 years that I've been here have entered the market and left the market. Entered the market, left the market. They see the flow of money that's coming and they all want a piece of it. Then they get in and they really realize how difficult it is. So that's the biggest misconception.
I mean, especially when transactions slow down, it seems that, the people that have always been around kind of stay around and, people that try to, pan for gold, necessarily don't have all, if they don't have immediate luck, end up not sticking around.
Right. Exactly. Exactly right.
You have any final words of advice for your peers or new commercial real estate professionals in the sector today?
I would say, going back to my previous comments about, don't get locked into what product types or things that worked in the past and hoping they're going to work 10 years in the future. A lot of firms fall in love with a specific property type and keep saying this is going to come back, it's going to come back, or it's going to work and it doesn't work. Don't get caught up in that. Don't be scared to change. Don't be scared to innovate on new things. Live, work, play is a great example. Look at the macro trends. Some of them are very easy. AI, right? It's in the news every day. We're going to have more and more larger pools of data. You're going to have these data centers that run those, So, and that's not going away anytime soon for a long time. Right. So you're going to need data centers. The housing crisis I mentioned before is another one. So there's a number of these large macro trends that are in the news every day. Find a trend, find a property type that you like, or if you like the capital markets, products that you believe are great for investors, and work those, and you'll always have quite a bit of success.
Excellent. I mean, that's great advice. And, this brings us to the end of our talk track. Mark, thank you so much for joining us. It's been really great to hear your insights, especially on such timely and important topics. I know you're very busy, so we appreciate you taking the time to sit with us today.
It's my pleasure. I really appreciate being on, and thanks so much for reaching out to us. And just happy to do it.
Absolutely. And where can people find you online if they want to get in touch? Social media, email?
Yeah, I would say social media on LinkedIn. You can find me on LinkedIn under our Hines address, Mark Earley. If you want to learn more about our private wealth solutions and what we have on our platform, you can visit us at hinesprivatewealth.com. So it's HINESPrivatewealth.com. And where you can find any of the information you need.
Mark, thank you for that. And thanks to everyone who tuned in today. If you enjoyed this episode, do not miss the next one. Visit Crexi.com/podcast and sign up to get the next episode delivered directly to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app or check out our YouTube channel for video recordings of each episode. Take care and be sure to tune in next time.